Shotgun with Richard again. Let's chat a moment about credit and credit scoring. First, a little disclaimer that basically I'm definitely a loan consultant, loan officer. We understand credit and credit scoring models and how they work, but we are not a credit restoration or a credit repair company. So depending on the complexity of your credit profile, we may refer you over to a professional that's all they do, is help people restore credit and build credit. But when it comes to credit scoring and home loans, there's a lot of misunderstanding out there, because when you look at your own credit score, you may see a number. For an example, you might see a 700 on your Credit Karma or your credit card that gives you your score. And then I pull credit for a home mortgage, and it might be higher or lower. A lot of times it's lower, and I'll tell you why. It's because it's a different algorithm when you're generating a score for a mortgage inquiry. It's my understanding that inquiry actually looks at a 7-year look back on your credit profile, whereas those other agencies for other pulls, like Credit Karma, those different agencies, they're only looking at a 2-year look back. So same thing when you buy an auto loan, it's gonna generate the highest score than a mortgage will. So just know that. Obviously, the higher the credit score, boy, it's sunny out today. Sorry about that. Higher the credit score, better the loan products. There's certain loan products that your credit score isn't as detriment, especially some new provisions for first-time home buyers within a certain area median income. It's not as detriment to your loan product, but if you're doing a conventional loan and you have a lower credit score, even with those loan products, your mortgage insurance is going to be higher than on a lower credit score than a high credit score. So you're always going to get the very best loan with the highest credit. So how do you optimize your credit score? Is definitely on the revolving accounts. Keep those at a low balance. So if you have a $5,000 limit, don't max that out. And especially, I see it really detriment if you go over your limit, and or if you have any past due balances for whatever reason. If it reports past due, it really hurts the credit. Obviously, late payments hurt. Day and night time, not having a 30-day late, that's the key. If you're a few days late, you incur a late fee, it's not going to report to credit that you're 3 days late, but it will report if you're 30 or more days late. So be sure to pay on time. On those installment loans, auto loans, personal loans, things like that are listed as installment, sometimes it's better to not completely pay those off when you're trying to buy a house, because once those are paid off, it's going to rate your scoring a little different, because it's a closed account once it's paid off on an installment loan. So sometimes what we'll do is we'll encourage them just to keep paying it as agreed, and or if you pay it down lower, so you're paying it off sooner than the agreed upon installments, it helps as well. At least that's what I've noticed. So that's my 2 cents on credit scoring. Collection accounts and things like that, I'm not going to get into those today. It gets a little complicated on if you pay those off, then it triggers a new date. Does it negatively impact you? Some of that really depends, honestly. Past due is bad, so a collection that is also listed as past due really hurts. So when we get into those, sometimes I will refer it over to a credit collection, not collection, but credit repair agency to give the best advice on how to handle those. Sometimes they can get things removed. Anyway, have a great day, everybody. Chat soon.